3 years ago, Jamie Rodriguez was stocking shelves at a grocery store for $12 an hour. Today, she manages a portfolio worth $1.8 million and hasn't had a losing quarter in over 2 years. But here's what makes Jamie's story absolutely mind-blowing. She started with just $100 in a smartphone. No rich parents, no insider tips, no secret algorithm. Just $100 and something far more powerful than any trading strategy ever created. What Jamie discovered changed everything she thought she knew about making money in the markets. And by the end of this video, you'll understand why her approach works while 90% of other traders lose money, and how you can apply the exact same principles starting today. But first, let me ask you something. Have you ever wondered why some people can turn tiny accounts into life-changing wealth, while others blow through thousands of dollars and have nothing to show for it? Why do smart, successful professionals often fail miserably at trading, while complete beginners sometimes strike it rich? The answer isn't what you think. Most people believe trading success comes from finding the right stocks, learning complex chart patterns, or following expert predictions. They spend fortunes on courses, software, and trading systems, convinced that somewhere out there is a secret formula for guaranteed profits. They're looking in completely the wrong place. What if I told you that the difference between traders who consistently make money and those who consistently lose it has almost nothing to do with market knowledge? What if the secret wasn't hidden in technical indicators or fundamental analysis, but in something much more fundamental? Something that happens in the 3 inches between your ears. Jamie discovered this truth the hard way. During her first 6 months of trading, she lost her initial $100 3 separate times. She tried day trading penny stocks, following Twitter gurus, and copying trades from YouTube influencers. Every approach ended the same way, a zero balance and crushing disappointment. But Jamie's story takes a remarkable turn when she stumbled upon a concept that changed everything. It wasn't a new strategy or a hot stock tip. It was a fundamental shift in how she thought about trading itself, a mindset adjustment that transformed her from a chronic loser into a consistent winner almost overnight. Here's what Jamie realized. Your brain is your worst enemy when it comes to trading. Think about it. For millions of years, human survival depended on making quick emotional decisions. See danger? Run immediately. Find food? Grab it before someone else does. Spot an opportunity? Act fast or lose out forever. These survival instincts kept our ancestors alive, but in modern financial markets, they're absolutely deadly. When you see your trade losing money, your ancient brain screams, "Emergency!" and floods your system with stress hormones. Suddenly, you're not making logical decisions based on probability and risk management. You're reacting like a caveman seeing a tiger. This is why brilliant doctors, successful lawyers, and accomplished engineers can completely fail at trading. It's not about intelligence or education. It's about understanding that your natural psychological responses are perfectly designed to lose money in the markets. But here's where Jamie's discovery becomes truly powerful. Once you understand how your mind works against you, you can train it to work for you instead. Professional traders have known the secret for decades. They understand that trading isn't really about predicting market movements. It's about controlling psychological responses to uncertainty. They've developed specific mental techniques that allow them to stay calm and rational even when thousands of dollars are on the line. Jamie learned these same techniques. She discovered how to recognize when her emotions were taking control and developed systems to make decisions based on logic instead of fear or greed. She learned to think like a business owner rather than a gambler. The results were immediate and dramatic. Within 2 months of implementing these psychological principles, Jamie had her first profitable month, then another, then another. Her account balance started growing steadily, compounding month after month, eventually reaching the millions. Now, you might be thinking, this sounds great, but what exactly are these psychological techniques? How do you actually train your mind for trading success? That's exactly what we're going to explore. But before I reveal the specific methods that transform Jamie's results, I need to tell you about the single biggest mistake that destroys more trading accounts than bad stock picks, poor timing, and market crashes. This mistake is so common that virtually all traders make it at some point. It's so subtle that most people don't even realize they're doing it. And it's so dangerous that it can turn winning trades into devastating losses in a matter of minutes. What is this account-killing mistake? And more importantly, how can you recognize it in yourself before it's too late? Because understanding this psychological trap might be the difference between joining the 90% who lose money and the 10% who consistently profit. The answer might shock you because it has nothing to do with market analysis or stock selection. Thomas would enter a position based on careful analysis and a clear plan. Let's say he bought a stock at $50 with a plan to sell at $45 if it went against him. The stock immediately dropped to $48. Logically, Thomas knew this was normal market volatility. His research was solid, his plan was reasonable, and a $2 fluctuation meant nothing. But something else was happening in Thomas's brain that he didn't understand. His amygdala, the primitive alarm system responsible for survival responses, detected the price drop as a threat. Within milliseconds, it triggered a cascade of stress hormones. Cortisol, adrenaline, and norepinephrine flooded his system. His heart rate spiked, his palms got sweaty, and suddenly, that small paper loss felt like a life or death emergency. This is where the psychological trap springs shut. Under stress, your brain shuts down the prefrontal cortex, the rational thinking center, and hands control to the emotional limbic system. Thomas was no longer making decisions like a careful analyst. He was reacting like a panicked animal. What happened next follows a predictable pattern that destroys accounts worldwide every single day. First, Thomas started checking his position obsessively. Every few minutes, he'd refresh his portfolio to see if the stock had recovered. Each time it hadn't, the stress response intensified. What started as mild concern escalated into consuming anxiety. Second, Thomas began seeking information that would make him feel better. He scoured news articles, analyst reports, and online forums looking for anything that confirmed his original decision was correct. He found some positive articles and felt temporarily relieved, but ignored the negative signals that suggested his thesis might be wrong. Third, and most dangerously, Thomas started moving his stop loss. His original plan was to sell at $45, but when the stock hit $46, he convinced himself to give it just a little more room. When it hit $44, he moved the stop to $40. When it hit $41, he removed the stop loss entirely, telling himself he'd wait for it to come back. The stock eventually bottomed at $31 before Thomas finally sold in desperation. He had turned what should have been a manageable 10% loss into a devastating 38% loss, all because his brain was hijacked by prehistoric survival responses. This pattern repeats millions of times every day in trading accounts around the world. Intelligent, rational people make catastrophic decisions because they don't understand how stress affects their thinking. But Thomas's story gets worse. After taking that brutal loss, he was determined to win back his money quickly. This triggered another psychological trap called revenge trading. Instead of taking time to analyze what went wrong, Thomas immediately jumped into a riskier trade with a larger position size. His reasoning was simple. If I can make 40% on this next trade, I'll be back to even. This is where account destruction accelerates. Revenge trading combines the worst aspects of human psychology. Loss aversion, the pain of losing feels twice as strong as the pleasure of winning. The gambler's fallacy, believing that past losses increase the probability of future wins, and confirmation bias, seeing only information that supports what you want to believe. Thomas's revenge trades followed a predictable downward spiral. Each loss made him more desperate to recover. Each desperate trade was larger and riskier than the last. Within 3 months, his $20,000 account was down to $2,000. But here's what makes this tragedy even more heartbreaking. Thomas was actually a skilled analyst. His original stock picks were generally sound. His research methodology was solid. He failed not because he lacked market knowledge, but because no one had taught him how his own mind works under pressure. This is the silent account killer, the complete lack of psychological awareness among traders. People spend thousands of dollars learning technical analysis and fundamental research, but virtually no time understanding how their brains make decisions under stress. Professional traders approach this completely differently. They understand that trading is fundamentally a psychological game disguised as a financial one. They spend as much time training their mental responses as they do analyzing markets. Take Sarah Kim, who manages over $500,000 in trading capital. Sarah learned about psychological traps after blowing up her first account in exactly the same way Thomas did. But instead of giving up, she studied trading psychology and developed specific techniques to control her emotional responses. Sarah's approach is built on a simple principle: never make important decisions while experiencing strong emotions. When she feels her stress level rising during a trade, she has predetermined protocols that kick in automatically. If Sarah rates her emotional intensity above a 6 on a 10-point scale, she's required to step away from her computer for exactly 15 minutes. During this cooling off period, she practices deep breathing exercises and reviews her original analysis for the trade. Only after her emotional state returns to baseline does she make any decisions about the position. This simple protocol has saved Sarah from countless emotional mistakes. More importantly, it's helped to recognize something crucial. Her strongest emotional reactions often coincide with the best trading opportunities. Sarah discovered that when she felt absolutely terrified to buy a stock that had crashed, it was often an excellent entry point. When she felt euphoric about a position and wanted to add more shares, it was usually time to take profits. Her emotions had become a contrarian indicator. This led Sarah to develop what she calls her fear thermometer. Instead of fighting her emotional responses, she learned to use them as information. High fear often signals oversold conditions and buying opportunities. High greed often signals overbought conditions and selling opportunities. But using emotions as information requires something that most traders never develop: the ability to observe your own mental state objectively while it's happening. This skill, called metacognition, is perhaps the most valuable capability any trader can develop. Professional traders train themselves to become observers of their own thinking. They learn to recognize thoughts like, "I can't take this loss," or "this stock is definitely going to recover," as emotional reactions rather than logical analysis. This observer mindset creates psychological distance from trading outcomes. Instead of being emotionally attached to every position, professional traders maintain the detached perspective of a business owner reviewing quarterly reports. But developing this observer mindset isn't automatic. It requires specific training techniques that most traders never learn. It demands daily practices that strengthen your ability to think clearly under pressure. What are these specific training techniques? How do you develop the mental discipline that separates amateur traders from professionals? And what daily practices do successful traders use to maintain emotional control when their accounts are swinging by thousands of dollars? The answers lie in understanding how professional traders structure their entire approach to thinking about risk, probability, and decision-making. At exactly 5:30 a.m. every morning, before touching her phone or checking any markets, Lisa Martinez sits quietly in her home office and does something that's made her over $900,000 in the last 4 years. She doesn't check futures prices or scan for breaking news. She doesn't review her positions or calculate potential profits. Instead, Lisa spends 20 minutes practicing what elite traders call mental rehearsal, and it's the foundation of professional trading psychology. Here's what Lisa is actually doing during those 20 minutes that's worth more than any stock tip or trading system you could buy. Lisa visualizes herself in various trading scenarios, but not the way most people think. She doesn't imagine herself making huge profits or picking perfect trades. Instead, she mentally rehearses her responses to stressful situations, watching a position drop 10%, seeing profits evaporate on a winning trade, or facing the decision to cut a loss short or hold on longer. But here's the crucial part. During these visualizations, Lisa practices responding with complete emotional neutrality. When Lisa imagines her account dropping by $5,000 in a single trade, she mentally rehearses her exact response, check the fundamentals, review her exit criteria, execute her predetermined plan without emotional interference. She practices this scenario over and over until her brain learns to associate trading stress with calm, systematic responses instead of panic. This technique is based on neuroscience research, showing that mental rehearsal creates the same neural pathways as real experience. By repeatedly visualizing controlled responses to market stress, Lisa literally rewired her brain for trading success. But mental rehearsal is just one tool in the professional trader's psychological toolkit. The second technique is even more powerful because it changes how you interpret market events in real time. Professional traders use something called narrative reframing, the practice of consciously changing the story they tell themselves about what's happening in their trades. Here's how this works. When amateur trader Mike sees his stock drop 8%, his internal narrative automatically becomes, "I'm losing money, this is bad, I made a mistake, I need to fix this immediately." This story triggers stress, anxiety, and impulsive decision-making. But professional trader Anna sees the same 8% drop. Her reframed narrative is, "The market is providing new information. This movement might be temporary volatility, or it might signal a change in my original thesis. I should gather more data and compare it to my predetermined criteria before taking any action." Same event, completely different story, totally different emotional response and outcome. Anna learned this reframing technique after losing $25,000 in her first year of trading. She realized that her brain was automatically creating dramatic, negative stories about normal market fluctuations, and these stories were triggering emotional decisions that destroyed her account. So Anna trained herself to replace automatic emotional narratives with neutral, fact-based observations. Instead of thinking, "This stock is killing me," she learned to think, "This position is currently down 8%. Instead of, "I'm such an idiot for buying this," she trained herself to think, "This trade isn't performing as expected." The difference in emotional impact is enormous. Emotional narratives trigger stress responses that shut down rational thinking. Neutral observations keep the analytical brain engaged and allow for logical decision-making. But professional traders don't just manage emotions during trading. They use a third technique that's even more sophisticated. They actively leverage emotional responses as market intelligence. Lisa discovered this during her second year of consistent profitability. She noticed that her gut reactions to market situations often contained valuable information that her analytical mind had missed. The key was learning to distinguish between useful emotional information and destructive emotional reactions.
For example, when Lisa feels genuine excitement about a potential trade based on solid research, that enthusiasm often signals she's identified a high-probability opportunity. But when she feels desperate excitement about a trade that would save a losing month, that emotion is warning her about poor decision-making. Lisa developed what she calls her emotion audit, a systematic way to evaluate her feelings before making trading decisions. She asks herself 3 questions. First, what emotion am I feeling right now, and how strong is it on a scale of 1 to 10? This creates awareness of her mental state. Second, is this emotion based on analysis and probability, or on ego and attachment to outcomes? This distinguishes between useful intuition and destructive bias. Third, what would I do in this situation if I felt completely neutral? This accesses her analytical judgment without emotional interference. If Lisa's emotions are above a 7 in intensity, or if they're based on ego rather than analysis, she waits at least 1 hour before making any trading decisions. During that cooling off period, she uses a 4th professional technique, systematic probability assessment. Instead of thinking about trades in terms of right or wrong, professional traders think in terms of probability and expected value. When Lisa considers a trade, she doesn't ask, "Will this stock go up?" She asks, "What's the probability this trade will be profitable, and what's the expected return relative to the risk?" This probabilistic thinking completely changes the psychological experience of trading. When you think in terms of individual trades being correct or incorrect, losses feel personal and trigger emotional responses. When you think in terms of probability distributions over many trades, individual outcomes become statistical data points rather than judgments on your ability. Lisa calculates expected value for every trade before entering. Probability of profit times average profit amount minus probability of loss times average loss amount. She only takes trades with positive expected value, and she's completely comfortable with the fact that roughly 40% of her individual trades lose money. This mathematical approach to trading provides enormous psychological benefits. Lisa doesn't take losses personally because she expects them as part of her statistical system. She also doesn't get overconfident from wins because she understands that short-term results contain significant random variation. But implementing these psychological techniques requires a fifth professional tool: environmental design for optimal decision-making. Professional traders structure their physical and digital environments to support good psychology and prevent bad decisions. Lisa removed all market news alerts from her phone because she realized that breaking news usually triggered emotional reactions rather than useful analysis. She also programmed her trading platform with automatic safeguards. Every position has a predetermined stop loss that executes without her emotional input. She can't place market orders, only limit orders, which forces her to think about exact prices rather than making impulsive trades. Some traders go even further with environmental controls. They give trading partners authority to close their accounts if they deviate from predetermined rules. They set up automatic position sizing that prevents them from risking too much when emotions run high. The goal is to make good decisions as easy as possible and bad decisions as difficult as possible. When your amygdala is flooded with stress hormones, you want your environment to guide you toward rational responses rather than emotional ones. But all of these professional techniques depend on the most important foundation of all: daily practices that strengthen your mental discipline and maintain peak psychological performance. What do these daily practices look like? How do professional traders structure their entire day around maintaining emotional control and mental clarity? And what specific routines do million-dollar traders use to stay sharp when the pressure is on? The answers might surprise you, because they have very little to do with market analysis and everything to do with treating your mind like the high-performance instrument it needs to be.
Every single morning at 6:15 a.m., before looking at a single chart or reading any market news, Alex Chen performs a ritual that's helped him grow his account from $500 to over $1.2 million in just 5 years. Alex sits in his home office, opens a plain notebook, and writes down exactly 3 things: his energy level on a scale of 1 to 10, his emotional state in 1 word, and his level of confidence about his current positions. This 30-second exercise has prevented more trading disasters than any technical analysis he's ever learned. Why does this simple daily assessment have such powerful effects on trading performance? And what other daily practices do professional traders use to maintain the mental edge that separates them from amateur traders? The answer lies in understanding that trading success isn't just about market knowledge. It's about maintaining peak mental performance day after day, month after month, year after year. Alex discovered this principle the hard way during his 2nd year of trading. He had developed a solid strategy and was making consistent profits, but his results were wildly inconsistent from day to day. Some days he'd trade perfectly and make excellent decisions. Other days he'd break his own rules and give back weeks of profits. The breakthrough came when Alex started tracking his mental state alongside his trading results. He discovered that his worst trading days consistently followed poor sleep, high stress, or emotional situations in his personal life. His best trading days followed good rest, balanced nutrition, and calm emotional states. This wasn't coincidence. Neuroscience research shows that decision-making ability, emotional control, and risk assessment all depend on your brain's physical condition. Stress hormones, blood sugar fluctuations, and sleep deprivation directly impair the cognitive functions you need for successful trading. Once Alex understood this connection, he completely redesigned his daily routine around maintaining optimal mental performance. Here's exactly what his day looks like now. 6 a.m. Wake up naturally, no alarm after months of consistent sleep schedule. 6:05 a.m. Large glass of water and light stretching, rehydration and gentle activation. 6:15 a.m. Mental state assessment in trading journal, self-awareness check. 6:20 a.m. 15 minutes of focused breathing or light meditation, stress regulation. 6:35 a.m. Reviewed trading plan and key levels prepared the previous evening, no reactive decision-making. 7 a.m. Nutritious breakfast while reading general news, stable blood sugar, broad perspective. 7:30 a.m. Final market preparation and position planning, fresh analysis with clear mind. 8:30 a.m. Markets open, execute only predetermined trades. Notice what's missing from this routine. No immediate phone checking, no social media scrolling, no reactive news consumption. Every element is designed to put Alex in the optimal mental state before he risks a single dollar. But the morning routine is just the foundation. Professional traders like Alex understand that mental discipline must be maintained throughout the entire trading day. Alex uses what he calls cognitive load management, the practice of preserving mental energy for the decisions that actually matter. Research shows that decision-making ability degrades throughout the day as you deplete your finite mental resources. Every choice you make, from what to wear to what to eat for lunch, uses up psychological energy that could be better spent on trading decisions. So Alex automated every possible non-trading decision. He wears the same style of clothes every day, different colors, same style. He eats the same healthy breakfast every morning. He has predetermined lunch options that require no decision-making. This isn't about being boring, it's about preserving cognitive resources for trading. Alex also implements strategic energy breaks throughout his trading day. Every 90 minutes, he steps away from his screens for exactly 10 minutes. He might walk outside, do push-ups, or simply sit quietly. These aren't procrastination breaks, they're performance optimization breaks, based on research showing that sustained attention starts declining after about 90 minutes of focus.
During these breaks, Alex never checks social media or reads market commentary. Instead, he uses techniques designed to reset his mental state. Deep breathing to activate his parasympathetic nervous system, brief physical movement to increase blood flow, or positive self-talk to reinforce his systematic approach. But perhaps the most powerful element of Alex's daily system is something he does every evening, a systematic performance review that focuses on process rather than outcomes. At 6 p.m. every day, Alex spends exactly 20 minutes reviewing his trading day. But instead of focusing on profits and losses, he evaluates his decision-making process. He asks himself 5 specific questions. 1. Did I follow my predetermined entry criteria for every trade? 2. Did I manage position sizes according to my risk rules? 3. Did emotions influence any of my decisions today? 4. What did I do well that I should continue? 5. What can I improve tomorrow? Each trade gets rated on a scale of 1 to 5 for execution quality, regardless of whether it made or lost money. A losing trade that followed all his rules perfectly gets a high rating. A winning trade that broke his discipline gets a poor rating. This process-focused review system creates what psychologists call intrinsic motivation. Instead of being motivated by external results, money gained or lost, Alex becomes motivated by internal satisfaction from executing his system correctly. This psychological shift makes discipline feel rewarding rather than restrictive. The evening review also serves another crucial function. It helps Alex identify patterns in his decision-making that might not be obvious in the moment. Maybe he notices that he makes his best trades on Tuesdays but struggles on Fridays. Maybe his discipline deteriorates after lunch. Maybe certain types of market conditions trigger emotional responses. These patterns become opportunities for system improvement rather than personal failures. Professional traders understand that consistency comes from systematic improvement, not from trying harder or having more willpower. But Alex's daily system includes one more element that might be the most important of all: physical optimization for mental performance. Alex treats his body like the foundation for his mind. He prioritizes 7 to 8 hours of sleep because sleep deprivation impairs judgment, increases emotional reactivity, and reduces impulse control, exactly the opposite of what you need for trading success. He maintains stable blood sugar through balanced nutrition because glucose fluctuations directly affect decision-making ability and emotional stability. He exercises regularly because physical activity reduces stress hormones, improves mood, and enhances cognitive function. Alex learned this lesson after tracking his trading performance against his lifestyle habits for 3 months. His worst trading days consistently followed poor sleep, high sugar intake, or skipped workouts. His best trading days followed good sleep, balanced nutrition, and regular exercise. This isn't just correlation, it's causation based on well-established neuroscience. Chronic stress elevates cortisol, which impairs memory and increases emotional reactivity. Poor nutrition creates blood sugar spikes and crashes that affect judgment and impulse control. Lack of exercise reduces neuroplasticity and increases anxiety. Professional traders optimize their physical health not for general wellness, but as a competitive advantage in the markets. But even with perfect daily routines and systematic discipline, every trader faces moments of extreme market stress that test their psychological limits. Crashes happen, unexpected news breaks, volatility spikes, accounts swing by tens of thousands of dollars in minutes. This is where the final piece of professional trading psychology becomes absolutely crucial: the ability to maintain perspective and make rational decisions even during market chaos. How do professional traders stay calm when their accounts drop 20% in a week? What mental frameworks allow them to think clearly during maximum stress? And what's the one psychological principle that lets them sleep peacefully even when significant money is at risk? These final insights reveal the deepest level of professional trading psychology.
October 19th, 2020. The market opens in free fall. Within the first hour of trading, the S&P 500 drops 6%. Panic selling is everywhere. Social media explodes with traders posting screenshots of devastating losses. CNBC runs continuous coverage about market collapse. While amateur traders around the world are paralyzed with fear or making desperate trades to salvage their accounts, professional trader Maya Patel is sitting calmly at her desk, reviewing her notes from the previous evening. Her account is down $47,000 for the day, more money than many people make in a year. But her heart rate is steady and her thinking is clear. What allows Maya to remain composed while others are having panic attacks? How can someone watch nearly $50,000 disappear and maintain perfect emotional equilibrium? The answer reveals the deepest secret of professional trading psychology: the ability to think in systems rather than events. Maya doesn't view today's market drop as a catastrophe requiring immediate action. She views it as a single data point in a long-term probability distribution that she's been prepared for months. Her calm response isn't because she doesn't care about money. It's because she understands something about markets and mathematics that most traders never learn. Professional traders like Maya operate from what psychologists call a systems mindset. Instead of focusing on individual trades or daily account fluctuations, they focus on the mathematical properties of their overall approach over hundreds or thousands of trades. Here's how this works in practice. When Maya enters any trade, she doesn't think this stock will go up or this trade will make money. Instead, she thinks, based on my analysis, this type of trade setup has historically been profitable 64% of the time, with an average gain of 7.2% and an average loss of 3.1%. This shift from predicting individual outcomes to understanding statistical probabilities completely transforms the psychological experience of trading. Maya doesn't need any single trade to work because she knows her system generates positive results over many trades. When today's market crash triggered stops on 3 of Maya's positions, she didn't experience emotional distress because those losses were already factored into her statistical expectations. She had calculated months ago that her system would experience drawdowns of 15 to 25% several times per year, and today's results are well within those parameters. This is the mathematical foundation of professional trading psychology. Positive expected value thinking combined with proper risk management creates psychological immunity to short-term market chaos. But Maya's systems mindset goes even deeper. She doesn't just think probabilistically about individual trades, she thinks probabilistically about her entire approach to wealth building. Maya understands that her trading account is just one component of a larger financial system that includes her career income, savings rate, investment timeline, and risk tolerance. Her trading results don't need to be perfect because they're part of a diversified approach to building long-term wealth. This broader perspective allows Maya to take appropriate risks in her trading without the paralyzing fear that destroys most amateur traders. She can afford to lose her entire trading account, though her system makes this extremely unlikely because it represents risk capital rather than money she needs for living expenses. Amateur traders often make the fatal mistake of trading with money they can't afford to lose. When your rent money or retirement savings is on the line, every fluctuation becomes emotionally overwhelming. Your brain treats each loss as a threat to survival, triggering the stress responses that lead to poor decision-making. Professional traders solve this problem by clearly separating their trading capital from their living expenses and long-term savings. Maya's trading account represents exactly 8% of her total net worth. This position sizing allows her to pursue aggressive growth strategies without threatening her financial security. But the systems mindset provides another crucial psychological benefit. It eliminates the ego attachment that destroys so many trading careers.
When amateur traders make money, they feel smart and skillful. When they lose money, they feel stupid and incompetent. This emotional roller coaster makes consistent decision-making impossible because each result becomes a judgment on their personal worth. Maya experiences none of this psychological turbulence because she understands that short-term trading results are largely random. Her self-worth isn't tied to daily account fluctuations because she knows that individual outcomes don't reflect her skill level. Instead, Maya judges her performance by how well she executes her systematic process. She maintains detailed statistics on her decision-making, the percentage of trades that followed her entry criteria, how often she stuck to her position sizing rules, whether she let emotions influence her exits, and how consistently she followed her overall system. A month where Maya loses money but executes her system perfectly is a successful month. A month where she makes money but breaks her discipline is a warning sign that needs correction. This process-focused evaluation system provides enormous psychological benefits. Maya's confidence doesn't fluctuate with her account balance because her confidence is based on systematic execution rather than random results. She also avoids the dangerous overconfidence that comes from winning streaks. When Maya has a series of profitable trades, she doesn't assume she's figured out the market or increase her risk levels. She understands that short-term success often contains significant luck, and she maintains consistent risk management regardless of recent results. This leads to perhaps the most important aspect of professional trading psychology: emotional immunity to the extreme events that destroy amateur traders. Market crashes, flash crashes, unexpected news events, and extreme volatility are not aberrations that professional traders try to avoid. They're expected features of financial markets that are already incorporated into their thinking. Maya has studied market history extensively. She knows that 20% corrections happen roughly every 2 to 3 years. She knows that 5% daily moves occur several times per year. She knows that black swan events that seem impossible actually happen with surprising regularity. More importantly, Maya has prepared psychologically and financially for all of these scenarios. She has predetermined responses for various market conditions. She has calculated exactly how much her account could lose in extreme scenarios. She has stress-tested her system against historical market disasters. This preparation creates what Maya calls scenario immunity. When extreme events occur, she doesn't need to figure out how to respond, because she's already planned her response months or years in advance. During today's market crash, Maya simply referred to her predetermined plan for high volatility scenarios. She reduced her position sizes slightly, reviewed her stop-loss levels, and looked for potential opportunities that might emerge if the selling continued. No panic, no emotional decisions, just systematic execution of a pre-planned response. But perhaps the most powerful aspect of the system's mindset is how it changes your relationship with time and wealth building. Amateur traders often approach markets with a get-rich-quick mentality. They want to turn small accounts into large ones as fast as possible, which leads to excessive risk-taking and emotional decision-making.
Maya thinks in decades rather than days. She understands that sustainable wealth building requires patience, consistency, and compound growth over long periods. Her goal isn't to hit home runs on individual trades. It's to achieve modest but consistent returns that compound into extraordinary long-term results. This long-term perspective provides psychological stability during short-term turbulence. When Maya's account drops during market stress, she doesn't see temporary losses. She sees potential opportunities to deploy capital at better prices. Maya's systems mindset extends beyond trading into every aspect of her financial life. She understands that true wealth comes from multiple income streams, controlled expenses, tax optimization, and systematic saving and investing over many years. Trading is just one component of this larger system. It provides growth potential and portfolio diversification, but it's not expected to solve all her financial problems or replace her need for career development and long-term investing. This balanced approach creates the psychological freedom to trade well. Maya can take appropriate risks and maintain discipline because her entire financial future doesn't depend on trading success. The systems mindset, combined with emotional control techniques, daily discipline practices, and probabilistic thinking, creates what professional traders call trading serenity, the ability to participate in financial markets without the emotional chaos that destroys most amateur traders. But the real power of these psychological principles extends far beyond trading itself. The same mental skills that make Maya a successful trader, systematic thinking, emotional regulation, probabilistic reasoning, and long-term perspective, make her more effective in every area of life. And that's the ultimate secret that transforms $100 traders into millionaires. It's not about the money you start with or the strategies you use. It's about developing the psychological skills to make rational decisions under uncertainty, maintain discipline over time, and think systematically about probability and risk. These skills are learnable. Maya wasn't born with special abilities. She was an ordinary person who learned extraordinary psychological techniques and applied them consistently over time. The markets gave her the opportunity, but her mind created the results. The choice is yours. You can continue approaching trading with the same psychological patterns that cause 90% of traders to lose money, or you can learn the mental skills that separate professionals from amateurs.